out of the markets. And the truth is that if you sabotage yourself, then it's really hard to get what you want. And that may sound really harsh, and it's not meant to sound really harsh, but the truth is that until you're trading in a way where you don't know what you're doing wrong, you're not really pushing yourself to the best of your ability, and it's very hard to move you forward. And that's one of the things that I'd like to come out of this. I'd like some people, I'd like all the people who listen to this and watch this over time to have that chance to understand that, it's you need to know, once you know what to do, you need to practice doing it. And it's I had my little 3-year-old up on the little playground down the road today, and he took his first step out into this slide that wobbles backwards and forwards, and he was terrified. The poor little fella, he was maybe a meter in the air on this playground. And I remember just saying to him, Jackson, mate, the first step's terrifying, and after that it's really simple. If you can take the first step, you can do the rest. And it's exactly the same with changing these kind of habits for a trader. We're really used to doing things in a certain way, and we're really used to sabotaging ourselves to some degree. And changing that, the moment you change that, it's really difficult. And the moment you've changed that, you look back on it and think, what the hell was that? How easy was
Absolutely.
that? I really encourage people to take that step,
Yeah, I totally agree. And actually, Helen's put in, it's really interesting understanding your own idiosyncrasies. And that's the point with it. How do we understand ourselves? How do we take an approach to understand ourselves? And I think some of the reason that people don't do it is that they don't really know how to, which I'll show you. This is the whole point of today's exercise, is to show you how to understand yourself. Because if we are fundamental analysts or we are technical analysts, we know the approach, and it's about analyzing in a technical analytical point of view. It's about making sure that we understand the charts and making sure we understand the chart patterns and what it's telling us to be able to take the right opportunities. But we need to be able to analyze ourselves. We need to be able to do the same analysis. And it's almost, if you are a fundamental analyst that goes to technical, then goes to the psychology of it. It's a 3-pronged attack. If you're just fundamental, then you still need the psychology. If you're just technical, you still need the psychology. So it really is important. It's really, really important that we get this stuff right. And as I say, there's tools that I'll show you that we can do that with.
Mate, we've got all kinds of varied and different stuff coming in the question and chat box. And I just want to remind you guys, we're here to do a show on a particular topic. And one of the things we're going to do on this show is stay on that topic. And we're being asked for analysis on this. And can we talk about that? And look, if you want that kind of stuff long term, just let me know. But in the middle of this show, I can't just wander off and do a lot of different stuff. If you're asking if we can, add different stuff on in the future, we can definitely add. We'll have different speakers come in and speak on different topics in the future. But I can't have astro analysis on copper right now. We're just not in that. That is, in fact, that's sort of the opposite of trading psychology for me. Jump out of the charts, guys. Get into your headspace and see if you can get your headspace right, and see if you can make a massive difference to your trading. Because look, again, it's really interesting today. I was going back through the some of the accounts end of month. I was having some end of month statements on the accounts from the Omnibus account, and the amount of people in the last month that lost between $0 and $200 for the month, and had one trade that lost more than that, staggered me, the percentage of people who had that. And I wondered when I was doing it, how good a trade that big losing trade was, the one that hurt them for the month, whether it was really a good trade, or really, that was the bad trade that took a month and they're paying for it. And I didn't go and have a look at them all, but I suspect some of those weren't great trades and there were people looking to chase the market, etc. And it ruined their month. And if they hadn't taken that trade, they'd have ended the month up and going to tick off another profitable month. And that kind of momentum is important. This is where the mental stuff really comes in. And mate, I have talked 4 minutes too long. It's over to you, mate. It is your presentation. Let's get into trading psychology.
Okay, fantastic. So, yes, this is about trading psychology. So let's start with this. The difference between, if you like, the profit, but the gap, the difference between being successful on this side and being a let's say unsuccessful. I'm not going to call it a failure because it's only a failure when you give up. So the difference between unsuccessful and successful is the difference between your potential and your profit line. So what that means is if we can unleash the potential and trade correctly, our profit line will improve. If we do not unleash our potential...
Mate, got a few people saying they'd like to see your screen.
Ah, sorry. Yeah, because I am writing. What screen am I in here? I think I am in this one. Here we go.
There we go, mate. There's potential and success. Over to you, buddy.
There we go. Okay, so this is the difference. I've got to make sure that the chat is in the right place. It's in my eye line here. Okay, so that's the difference we're looking for. The difference between the successful trader and the unsuccessful trader is the potential and the profit, which means that the gap is very, very thin. And you making the wrong decisions is sabotaging your potential success. And if you learn to make the correct decisions and learn the tools to make the correct decisions, then your potential profit will just grow exponentially. And it is something that you need to take time on. Now, that doesn't mean that you need to take a year. If you get the correct things in place, it can be done very, very early. But you have to do certain things to make sure that that happens. Now, there are three types of trader. These are the three types of trade. The ones that have seen their potential, they are consistent traders, and their profit line looks something like that. Then you get the boom and busts, the people that do this, woo, woo, and they're all over the place. Boom and busts, and then there's obviously the consistent loser. Now, you don't want to be on this. If you're a consistent loser, there is something significantly wrong about what you're doing. If you are a boom and bust, then you are halfway home. It's just correcting those bust situations. So you have to think about what kind of trade you are. Now, if you're a consistent loser, then you need to really start from the very, very start again. You need to build from the ground up. Boom and bust traders, they just need to go through correct processes to make sure that they get rid of those bust areas, because they can obviously pick winning trades. But there is something wrong in their psychology where they're allowing themselves to win consistently and then all of a sudden just blow it up, as Paul was talking about earlier. So what we need to be able to trade consistently is a relatively carefree mind. Okay, so we don't want to be kind of like overly thinking about trades. Now, there's different ways that you can do that. And one of the things that I was talking about in the show yesterday was that a reason that people don't have a relatively relatively carefree state of mind is because they are relying on each trade to make them enough money to live on. You know, so you can't go into trading and then all of a sudden say I'm a professional trader and that's that. You know, you've got to make sure that you know that for a fact before you can state it. Now, that may mean that you keep your job for a little while. You know, people want to leave their job and fire their boss the very next day. It's not a very clever thing to do, and completely unnecessary. You know, because you could do it within a year, but you need to have that backup either financially to make sure that you can pay your bills, you know, whatever that's going to be. So maybe having a job on the side, very important, or make sure that when you are trading, you are not over leveraging. So you are not putting so much on a trade that it's going to wake you up in the middle of the night, you know, because you're sweating on that trade working out. And if we think about what we teach our children, we always teach them to be patient. We're always saying to them, look, you will learn that as you go. You know, as Paul was saying, you know, telling Jackson to the first step is terrifying, but it becomes easier. No different when we're teaching people about being patient. Be patient to start with, and as you kind of progress, then you can be a lot freer in the way that you trade in and out the market. But you need to understand what you are doing first. So that's going to be almost the first lesson for it. So let me ask you guys these questions, okay? Now I want you to just make sure that you put it in the. Can you see the screen now, guys? You got, yep, cool. Okay,
mate, we've got a blank screen. Is that what we're supposed to have?
Yeah, blank screen's fine. Yeah, we can put up these questions. I want you guys to answer these for me, okay? So do you agree? It's about knowing yourself. Do you agree or disagree? And be honest. Nobody else can see this stuff. It's just to us. There must be a way to take a trade without loss. Agree or disagree? Just post in the chat box. Okay, we got varying sometimes. Okay, commit to it. Okay, I have trouble getting out of a losing trade. Who agrees with that? Who has trouble getting out of a losing trade? Okay, great. I appreciate your honesty, guys. Fantastic. Okay, so you plan your trades, but you don't execute them. Who has that problem where you've planned a trade almost to the nth degree, but you don't execute it? Fantastic. And you execute trades that you don't plan. So we are getting quite a few people that are agreeing with this. So you don't analyze your trades. Who doesn't analyze their trades? And I mean after the event. This is one of the key aspects. I don't analyze my trades sometimes, okay? Okay, fantastic. I only take trades, it only takes one trader anywhere in the world to negate my edge. Now, who agrees with that one? It only takes one trader anywhere in the world to negate my edge. Okay, got a few people saying yes, a few people saying no. You agree? Some people agree, some people don't agree. Okay, fantastic. I don't put on trades unless I'm certain that it's a winner. I don't put on a trade unless I'm certain it's a winner, okay? Quite a few people doing that one. Now, this is a big one. I always predefine my risk. Okay, some people do, some people don't. It's better to be honest with yourself, because while you're being honest with yourself, you're starting to go, hold on a minute. Hold on a minute, this might be something that I need to fix. And the final one is I blame the market for what went wrong. Yeah, okay. I mean, the thing is, you know, all of us have been in these situations. I can say that with some confidence that that each trader has had these problems. Okay, so trading is very much like the laws of the road. And this is the thing, we have to understand that when we sort of like going into the market, it's no different than most other endeavors that we participate in. If we were driving along the street and we don't wear a seatbelt, what could happen? What could happen if you were driving down the street? Doesn't matter how fast. Yeah, an accident could happen, but what could happen to you? Yeah, exactly. You could seriously hurt yourself. So if we drive in the wrong direction on the street, what can happen? If we drive drunk, what can happen? If we rush and we speed, what can happen? All this stuff can cause an accident. But if we think about it, if we do wear a seatbelt and we don't drive in the wrong direction and we don't drink and drive and we don't rush, could we have an accident? Could still happen, couldn't it? It could still happen. So in some respects, it's less likely. Maybe it's less likely. Might have less probability, but it still could happen because the laws of the road state that there are random things going on in society all of the time. So how do we know for sure when we leave the house in the morning that we are not going to have an accident? We don't know that. The reason that we wear a seatbelt and the reason that we don't drive down the street the wrong way, and the reason we don't drink and drive and don't rush is because it increases the probability that we will not have an accident. So what does that relate to in trading to you? Now and everybody's accepted. Yes. So what is that? Yes. Okay. Obey the rules. That's part of it. But what's the biggest thing? So what is a safety belt do? A seat belt do? Right. Simon's got it right. Simon said a stop loss is a seat belt, and that's exactly the situation. The stop loss is your seatbelt. And if you would wear a seatbelt because you know that driving down the street could cause some kind of random outcome, then why wouldn't you put a stop loss in because you understand that there could be a random outcome. Now, if we go back to some of these things about agree, disagree, there must be a way to take a trade without taking a loss. Now, I had some people agree with that, but let me tell you this, okay? And in fact, these are all grouped together. There must be a way to take a trade without taking a loss. I have trouble with getting out of a losing trade. I plan my trades, I don't execute, and execute the trades I don't plan. Okay, so this is the thing about an edge. Okay, and I asked this yesterday, so some of the guys in the room will know the answer. And I asked, does it only take one trade at anywhere in the world to negate your edge? And some people said no. But let me tell you, the answer is yes. Because what can happen is this. You can have a market going like this, and you know that you want to take a trade in this position here. And you've got your edge, okay? Your whole thing is lined up. Now, if we think about the reason that price moves from one point to the next point, you know, in either direction, let's put brackets around that instead. In either direction, all it takes is for somebody, all it takes is for the desire in the market to say that this price is cheap enough for me to make money if it goes to this price. Because at this point, we would perceive this as an expensive area. So we would be looking for the short, potentially, okay? If we are, if we're looking to get a short in the market here, then that might happen. If you have got, in fact, before we do that, if you've got somebody in JP Morgan, you know, the market's doing this. You got somebody in JP Morgan, the market's doing that, and all of a sudden there are all of the bigger players, let's say, all of the bigger players managed to get their positions here and here. So some of the bigger positions, some of the bigger players that sold off the market are no longer as interested here. They maybe not as they're not as liquid, and this could be on any time frame. So you could be looking on a monthly, a weekly, or whatever else that you could potentially be looking at. Now your edge has come in here. At this particular point, it only takes one trader from a big company to get on the phone and say, buy X. And as soon as they say buy X, it comes up and it changes what happened to your edge. So all of a sudden, your edge is negated. So that means that if we are accepting, we have to accept that every single trade has a random outcome. Because if it didn't have a random outcome, there would be a silver bullet that you had one strategy that always worked, and it doesn't. A strategy will not always work. And we can go and find out reasons. We can go and read any publication that we want to say that we are right about what's going on with a trade. But what happens to price, and the reason that prices move, is that there are people on one side of the argument that are willing to continue to buy the orders as they are sold off. Otherwise, there wouldn't be a print. If there was nobody willing here to buy the order, it couldn't come down. It would just stay at this price. Does that make sense to everybody? That the market is that the reason we get movements in price is because of change in the balance. So price can be here at 5, let's say, and the balance of buyers and sellers are equal. But it only takes one burst of a buy to put it up to 6, and enough people to accept that order to move the market in the opposite direction, which means that at any point it could be a random outcome. Now let's think also about why people may do this. Okay, let's say we've got prices going on like this. Prices going up and down and up and down. Now at this point we would expect the price to come down. Okay, now let's say that there are traders in this market that have bought, big trades I'm talking about, that have bought the market up here, and then the price dropped. Okay, that was their buy area there. That and the price dropped. What are they going to do? What are they going to try and do at this point to the market? What are they potentially going to try and do at that point? Yeah, exactly. Exactly, Yao. They're going to try and push the price up. Now, the way that they can push the price up is by buying lots and lots, putting lots of buy orders. They want to get rid of their positions here, but they don't want to get rid of it down here. They don't want to get rid of it here if they can get rid of it here. You know, that they want the best possible exit that they can, so they can buy the market up, creating more buy orders, because momentum means that other people start to switch in. And as those people switch in, then they can start offloading their shares, and then you see the market turn. Which means that even if you get the breakouts, it doesn't mean that the market's going to go and bounce. This is an obvious pattern. But why doesn't the pattern work out every time? And the reason it doesn't work out every time is that we don't know. We do not know what is really happening. Why does somebody buy and sell a market? We don't really know. You know, as I said yesterday, that there are people on news channels who speculate on. They are paid to find a reason that the market does, you know, something from one time to the next. But they don't really know. They're paid to speculate. They're paid to fill the news slot. So they've got to find a reason. But it could literally be, and honestly, this stuff does happen. It could literally be that the market came down there, and while all the other big guns were looking to sell here, they were out. They were off. They were out to lunch. No problem, Alan. You just don't know that. You just don't know what is happening to a market. And then all of a sudden that creates a vacuum and the price can push up again. So we need to understand that whatever we are doing with our setup, it has a random outcome. However, because that sounds kind of depressing, doesn't it? You sort of like think, well, if it's got a random outcome, what's the point in learning a strategy? And the reason that you learn a strategy is this. Those moments in the market that you have an accident has minimized, but it doesn't mean it won't happen once every now and again. So if we agree, and do we now agree that anything can happen on a trade by trade basis? Do we agree that over one trade, your edge could have been negated on a single trade, right? We agree. So in that case, straight away, why wouldn't you use a stop loss? If you agree that there is a risk that your trade could go wrong, and you know, and it would be one of those things. You do this, I don't use a stop, bang, I make loads of money. I do this, I don't use a stop, bang, I make loads of money. So you start to think that actually this using stop malarkey it's just pointless. But I tell you, it's the one that does this that sabotages your whole account and your whole future in trading. So yes, it can work. Not using stop losses can work on a trade by trade basis, but over the long period, it will crucify you. So there is no reason to not understand your risk and make sure that your risk is accounted for before you go into the market. Okay, so that's the importance of the stop loss. That's why we need to do it. Now back to the almost slightly depressing kind of fact that every single trade is random. No problem, Helen. We'll see you soon. Every single trade is no problem. Every single trade is random. So if we say that if we're looking at trades on a trade by trade basis, anything can happen. Then what's the point in having an edge? Well, the point in having an edge, and I asked this yesterday, let me ask you guys. In fact, let me put it a different way. If you've got a bookmaker, by the end of the year, with all the bookmakers' odds that they push out. In fact, firstly, does the bookmaker make money every single time somebody bets? Are there any bets that the bookmaker puts up? Right, they don't, right? Sometimes they'll put up a 14-1 and they'll get stung. Jeremy Corbyn, great example. I think he was like 400 to 1. Leicester City, another really good example. Donald Trump, good example. The bookmakers can get it wrong. But by the longer term, they know that their edge and their equation means that over the course of a long period of time, yes, over a course of a long period of time, they will. And it's no different than flipping a coin. So with a coin, we agree that the chances of it comes out heads to tail are 50%. Over 1,000, if we have 1,000 spins, the likelihood is it's going to come somewhere near 50-50. Over 1,000 spins, over a big, long period of time, it's going to be around about 50-50. But that doesn't mean that we might not get 20 tails in a row or 50 heads in a row. You know, it could happen. It'd be rare, but it could happen. You just don't know. But over the course of a long period of time, what we are stating is that we can surmise that the probability of us getting an even amount, relatively even amount between heads and tails is high. You know, the probability that that happens of 50-50 is high. The probability when the bookmakers do their calculations, the probability that they will make money on a year-by-year basis is high, and that's how they stay in business. They wouldn't be around for as long as they were. You know, the likes of William Hill wouldn't have been around for as long as they could if they didn't work in probabilities. So the first lesson today is that we need to start thinking in probabilities. The probability of your trade working out is random, but the probability of 20 trades working out gives you your edge. Okay, this is the edge. And the edge is over the course of 20 plus trades. Now, I was talking about this yesterday, and Simon in the room said around about a month. And depending on your strategy, it could be as little as a month. It might even be less than that, depending on your strategy. But let's say it was 2 months, just to be kind of a bit more conservative. Can you spend 2 months of your life doing things the correct way to potentially make an exponential amount of money? That's the question you need to ask yourself today. Can you spend a relatively short period of time making sure that you are ready for the markets when you really want to go in for it, to have a future in this industry? Or are you going to continue day on day to trade the way that you're trading and keep making the same mistakes over and over again? And as I say, it's a question that we'll come again to it later. But have you got the desire to change the way that you trade? If you are currently not doing things the right way, have you got the desire to change the way you trade? And the way you trade needs to be taken on a 20 minimum trade analysis rather than a trade by trade basis. Because if we think about it, if we have done our analysis, and this is the thing, let's say we've analyzed 20 trades properly. We've analyzed and executed 20 trades properly. If we are still a loser, that means there is something wrong with our edge. Okay? So it means that our edge either needs tweaking or we need to change it. But if we do not do this work, how can we possibly know if we've genuinely got an edge or not? Okay, so you've got to make sure that you are taking a decent sample size when you are looking to get your edge up and running, and when you're looking to make sure that your edge is a genuine one. Because you don't know. I mean, we're talking about any of the strategies that we teach you. You don't know whether they work. You don't know, you don't know whether you work with a strategy. You don't know whether the strategy works in every single market environment. You don't even know whether the strategy works on every single instrument. And how can you possibly know that unless you do the work? Okay? Now, I'm not saying that the strategies don't work. What I'm saying is that people might still have a nuance in a strategy that means that they can make it more successful than somebody else. And you cannot get to that point unless you've analyzed the trades and the situation yourself. So we've decided I think we talked about some of the trading errors. We can I can state some of the trading errors. I'll read them out really quickly. Just some of the trading errors that people make, because it's pretty much going to be covered from what we just said. But you don't decide to define the stop loss, and this is an error. This is an error. So if we accept it is an error, then we can stop indulging in these behaviors, because we know that on a trade by trade basis, if we trade correctly, because we've done our sample size, we're gonna make money. So we're going to start defining our stop loss before the trade is entered. Moving the stop loss as the trade comes against you, another trading error. Unless that is your strategy, you can't do that. You shouldn't do that, I should say. Hesitate when you've got your setup. Jump the gun and trade before the setup is complete. Or you may have a positive result, but when you indulge, so that was what I was talking about earlier. You might end up having a positive result from bad trading, but if you indulge in these behaviors, then the result can be catastrophic, and then you just wipe out your account. So you get out winning trades too soon and leave money on the table. It's another trading error. Letting winning trade turn into a loser, and I'm sure some of you are recognizing this. We've all done it. You know, we've all made these mistakes. Get stopped out of your entry price as the market turns back in your favor, which means that you've moved your stop so early, the market pops. Let's say you're trading down, you've entered, you've moved your stop, and the market goes down, pops back up again, closes your position, and then goes in your favor. These are genuine trading errors, and we need to be able to think in probabilities to make sure that we stop trading this way, so we don't put the pressure on a trade by trade basis, as we've now accepted that any single trade can have a random outcome and anything can happen. We don't know what's going to happen, and this is back to I'll only put a trade on if I am certain it's going to be a winner. How can you be certain it's going to be a winner? Impossible. It's completely impossible to predict the market and what the market might do on a trade by trade basis. All we are looking for is general patterns in the market to be able to take advantage of what should happen, or what should happen over a period of time. You know, and we can do this in life. If we know in life that if we go to the gym for 6 months that we're going to get some muscles and lose some weight, that should happen. But again, we're not going to do it, it's not going to happen in a week's time. So we've got to start thinking in probabilities. It's really important that we kind of get our mindset here. Okay. Now, these are the 3 points of development. Okay, this is how we need to start understanding how we're going to develop as traders. The first point of development is mechanical. Mechanical. Okay, now we have to be mechanical. We need to find out what works and what doesn't. And in this particular phase, and as I say, if you're still losing money making errors, then we start today, and in a month or 2 months time, you could have your mechanical methodology nailed. But you've got to understand the mechanics of what you're doing. It's really, really important. If you don't understand the mechanics, then forget it. You're going to be you're trading on intuition, which is a phase of trading, but you're going to be in your intuition phase too early, and it will hurt you. So if we with our mechanical phase, what we need to do is follow rules, and this has got to be rigid. And I accept that this can be incredibly tiresome. I accept that, and I accept that it can be just a bit laborious and a bit boring. But you've got to ask yourself, do I have the desire to do this? Because if I do, then I'll do what's right. And what's right is that you follow the rules rigidly when you're in the mechanical phase. And the mechanical phase would need to last a minimum of 20 trades where you have executed perfectly. Okay, so we're going to, and while we're in the mechanical phase, how are we going to protect our account let me just do it this way instead. How are we going to protect our account if we are going to be taking 20 trades and we don't know if we've got a strategy that works during the mechanical phase, because we've never done this before, okay? We're just going on guesswork. If we don't know for sure that we have got a strategy and an edge in the market, during the mechanical phase, you have to reduce your position sizing. Now, as I said yesterday as well, Paul has very generously kind of given people the trading account. You know, so with Paul's trading account, you're not even risking any of your own financial equity. But I would ask you to be respectful and say, okay, well, I'm not going to risk my own, but I will make sure that when I do make sure that I'm getting ready during the mechanical phase, that I reduce my capital, reduce your position sizing to a minimum, because this isn't about making money. This phase is about learning what works and understanding what works, taking the trades and getting good at taking the trades. Okay, so you reduce the size to minimal, and if you find that you can't execute your plan 20 trades in a row, then the mechanical phase has not been completed. You are not ready to increase your position size. You're not ready to move on to the next step. How do you, the way that you increase your probability on for every trade is to do the analysis on this. Because when you've done this, if you find, you've got to find out. That's the point. You've got to find out how I increase my probability. Do I know whether I've got an edge or not? Have I tested my strategy 20 times correctly, doing all the rules correctly? And what do my results give me? If it equals win, then we know that we can increase, then we know that our probability of winning is good. If it comes out badly, we know that this needs work. We know that phase one still needs work. And I can promise you that if you spend 1 to 2 to 3 to 4 months on this, it will save you years. If you don't do this work, you will still be in this position in 12 to 24 to 48 months' time. So do the work on this thing. Get good at being a mechanical trader. You can't take for granted that seeing setups means that you trade correctly. You can't take that for granted. You've got to trade it correctly. Go through the process. Make sure that your head is right. This is about psychology. Okay, now the next phase is the subjective phase. So we've had the mechanical phase. Now that leads us to the subjective phase. Now here, with the subjective phase, we are just tweaking the mechanical phase a little bit. So over the 20 trades, we can start being a little bit more subjective about the nuance of what would make the mechanical aspect of our trading slightly better. So we're not doing that with the first 20. We're making sure that we go through the whole process of the first 20. After we've done that first 20, then we can get more subjective about it, get a little bit more creative about the entries. Maybe we don't, maybe we've done the research and we found that actually, you know what, the low test bar works 60% of the time, but the engulfing bar has given me 10% return. So at this point, I'm going to be subjective. I'm going to tweak. I'm not going to trade with engulfing bars. Sorry, not 10% return. 10%. It only works out 10%. So 90% against us. So at that point, we can get subjective. We can start analyzing, you know, the way that we can improve our strategy. Okay. But you can only do, and even if your strategy, the mechanical phase has been wrong, you're still ready for the subjective phase. How can I improve the strategy? How can I find what works after the mechanical phase, after the subjective phase? Now, the final stage is the intuitive stage. And at this point, we want to be moving in and out of trades almost seamlessly. Okay, and at this point, you almost won't be able to explain what you're doing. You almost can't put into words exactly what it is that you know what has helped you achieve this. So the intuitive phase is something that you will get to. It's the most advanced phase, and it will be something that you get to when you've looked at the market a long time. Do you need the intuitive or subjective phase to make money? No. If you can get the mechanical phase right and it is making money, you can stick to being a mechanical trader and continue to make money and see your account grow exponentially. You don't need these other two. But the mechanical phase needs to be right first. The mechanical is the most important phase. So if you get that bit right, then you can not only move on to the next ones, but you might not need to. And you might not have time to. You know, people have got different commitments. So I understand that. Okay, so you need the profitable. You need to be, the first thing you need is the edge, and you're going to do that through the mechanical phase. Now you need to plan to utilize that edge. The intuitive phase is when you are moving in and out of intuitive is when you're moving in and out of trades, and you can't necessarily explain why. You know, it's almost like the black belt of karate, mixing styles. You know, sometimes you might sort of like see a slingshot set up, so you take that. Sometimes you might see a wave rider set up, so you take that. Sometimes you might see a fundamental buy. You've got a fundamental buy, so you take that. So the intuitive phase is the most advanced phase where you, as I say, you can't explain necessarily why something is. You know, you might start to kind of cross the streams a little bit with strategies. You know, it looks a little bit like that, but it's also got some of that to it. So, you know, I'm happy with what I've got, so I'm going to take the trade. So the intuitive phase is great. Okay, so we're gonna start thinking in probabilities. Okay, now nothing is going to be holding us back. Now, how do we do that is the question. How do we start thinking in probabilities? And the answer that every professional trader will tell you is that you have to journal. Okay, that's the tool that you need that will change your life. Okay, you've got to these are the tools of the industry. We've already kind of like looked through. I'm trying to find my thing on that. We've already looked through the charts. We've learned how to read charts. Okay, we know how to read charts. Now we need to learn how to read a spreadsheet of our journal. So you've got to make sure that you put down the products that you are trading. You've got to put down the date that you trade it on. These are just some of the things. Maybe you put the time in there as well of your journal. You know, you want to know whether you go long or whether you go short. You want to know what strategy you traded. You'd want to know your mindset. Now, it doesn't matter too much. Those of you that join me in the US show will know that we're working on journals. So for you guys, you're kind of getting pretty good, hopefully, at figuring out your categories. But it doesn't matter where, you know, what your categories are, as long as they work for you, as long as they make sense to you. But you've got to make sure that, yes, exactly, get your emotional preparation in for your trades. What is your reason for taking the trade? You know, what was the setup? It doesn't matter, as I say, what these categories are, but you have to have your categories right, and then you will note down every single trade that you take, and when you look at it, you will start to see patterns within those trades. And not only will you start to see patterns, but that's where we can help you again, because you can bring us the journal and you can say, can we go through my journals to see what I'm doing wrong? I still don't understand. Not a problem. As long as you've noted down your trades correctly, then we can go through it, and you might need you know, just a bit of extra coaching. You might need another eye to come in just to sort of say, I'll tell you what you're missing. But we can't do that just from somebody saying, I keep losing money. I don't know what you're doing. I don't know what you're doing. You don't know what you're doing. But you will start to know what you're doing. And I tell you how powerful this is. When you get this right, you will start to see little things that you go, geez, that's so obvious. That is so obvious. It's there in black and white. So the journal is your tool to helping your trading psychology. It will keep you on the straight and narrow. Now, when you do your journal and you have executed 20 trades in a row correctly, then you can analyze your edge. Okay. Now, I'm pretty much done on time, so I just want to give you one little story before I go. and ask you guys if you know who this is. Hold on one second. Any of you guys know who this guy is? Gotcha, mate. No idea. Okay, I'm going to tell you who he is. He is a guy called Tommy Caldwell, his name is, and he's a professional rock climber, and arguably one of the best rock climbers in the world. And he climbed this. This is El Capitan, 3,000 foot vertical face in Yosemite National Park. And he pioneered a new route to the top along the sheer granite cliff. So I'm just going to read you just one of the things that came out about the story about this, okay? This is the Dawn Wall and his desire to climb El Capitan. And this is the point. I know this is an extreme example, but if you want to change and you want to get good at trading, it is about desire. And the human being can do amazing things if they desire enough. So let me tell you, okay, this is just an article that was written about him. So he pioneered a new route to the top along the sheer granite cliff known as the Dawn Wall, which was previously thought to be an impossible climb. This ascent took 19 days and several years of preparation and nerves of steel. He was only accompanied by his climbing equipment and his fellow rock climber, Kevin Johnson. Now, does that seem quite impressive? Does it seem quite impressive to you? Of course. Got some people saying, of course. Okay, so let me tell you something about this guy. Before he climbed that, before he was due to climb El Capitan, he had a plank of wood, and he was building a little shed in his back garden, and he didn't put the safety catch on the circular saw, and he sawed off his is this your index finger? This part, the top part of his finger, clean off. It came right off. And this part of your finger, if you think about climbing, apparently these two fingers here are kind of how they get position on the wall. And he took the whole finger off before he climbed El Capitan. So the article goes on. If this does not seem difficult enough, Caldwell did this while missing a finger. At some point during his recovery, Caldwell records that a physician advised him to take up a new sport since he would never be able to climb well enough with a loss of a finger. And apparently, this provided him with additional motivation to return to his sport. He was so determined not to get back he was so determined to get back, not only to get back to where he was before the accident, but also to become a better climber. Caldwell performed extensive hand therapy, including exercises to desensitize the amputation site, improve range of motion of the hand, and maximize strength of the remaining fingers. Desensitization therapy involves specific exercises to reduce the pain of the amputation site. The cut nerve endings can be overtly painful to touch and hypersensitive, making the whole hand much harder to use. The range of motion exercises is critical because the hand becomes swollen and the fingers become very stiff after an injury. Strengthening exercises are important because the immobilization of lack of use quickly leads to muscle atrophy and hand weakness. Once he maximized his hand function, Caldwell then had to relearn how to use the hand for climbing without an index finger. So not only did he try and do it, he also had to do something new. Normally, the index finger is used for precision pinch, fine motor skills, and forceful grip. For rock climbers, the index finger is specifically used during a crimp hand position when holding onto a thin edge of a rock. The thumb is typically placed on top of the index finger in addition for pulling power and to support the large portion of the climber's body weight. And I'd imagine for a professional rock climber, learning to climb without an index finger would be like learning to walk again for most people. That's how massive it is. And he said it was very awkward. At first, he would try to use the finger normally, only to realize it wasn't there. Eventually, with time and dedication, he was able to train his hand to work about as well as it was before the injury. Tommy Caldwell's story is a testament to the human spirit. He defied the odds, proved his doctor wrong, and accomplished a feat that had eluded elite climbing members for years. So that is desire. Now that is extreme. But my point is that if somebody can, if we have within us the desire to do something, and there is an example of somebody that is able to complete his goal, even with an adversity that happened halfway through the preparation, then surely we can give ourselves a couple of months to analyze a few trades. Okay, that's pretty much me anyway. So I really, I hope it helped, guys, and I just really want to encourage you to take this on board and to do the work.
Mate, what I'd like to do now is I would like to, while I'm cleaning my glasses, because all of a sudden I tried to read a few things in and throw, I'm going to need this done. I really would like people to post any questions they've got about trading psychology in this process into the box. I'd like to have a bit of a chat with you about it. We're going to do a lucky draw before we finish. We're going to send them a couple of links. So that is still to come up. We'll do that towards the last few minutes of this. I'll get that ready for us. Look, for people who want to follow along and watch Ash on in his shows, the best way to do that is to subscribe to our YouTube channel. And if you want to subscribe to our YouTube channel, just click on the link that Maya's putting into the chat now, and that'll put you straight to a page where it'll just go, do you want to subscribe? And it will go, you just have to go yes or no. So if you want to subscribe to the YouTube channel, just click on that link and join. And let's have a look at, I don't think we've got any questions. I'm keen to have any questions you guys have got in. And I thought I might jump into this conversation a little bit. And I'm going to give you a simpler view of this. It's just my way, right? So if you want a backstop for trading psychology, first of all, I think Ash was really gentle with you. I think 20 trades is really nice and gentle, Ash. I think really more is better, right? If you do 20 trades, the data can be a little bit, get 50, 100 trades. Thank you very much for that, mate. Well, welcome for those who joined. 50 to 100 trades, you're starting to get some data that's usable. But what I'd also say to you is that one of the things Ash touches on here is that part of psychology, right, is to use the tools that traders use. You've got to journal properly. You've got to have a plan. You've got to analyze stuff and work out what works and what doesn't work for you in the time frame that you trade your strategy, because the truth is, even if we're trading the same strategy, we're all trading it at different times and looking at different things through our own biases. We think we're trading the same stuff, but one guy sees a high test bar and one guy sees a train track reversal and one guy sees an inside bar, and cyclicity can be different. There's so much stuff that we see through our own barriers looking in, that what we do need to do is take a lot of trades and go back and analyze them. And here's the thing for mine. If you want a test of trading psychology, have a trading plan. And if you're following that plan, your psychology is okay. And that plan may need fixing. And if you have a plan and you're not following that plan, then your psychology is not okay and you're not testing that plan. So for mine, it comes down to the accuracy of the speed of trader plan. And I think one of the things that Ash is talking about here, and sorry, Ash, we had some streaming problems, so I was in and out of the show a little bit. You feel free to jump in if this isn't the case.
Yeah, no worries. The one thing I would say about the 20 trades is that it will actually depend on your time frame of how you trade, because really you want a whole quarter of the year to kind of go. So you've seen most things in the market within the first quarter. So if you're a day trader, I would assume that you're probably if you're an end of day trader, I would say that you're probably around 20-25 trades by the end of the quarter. But you're right, if you're on shorter term timeframes, you will need a bigger sample size.
Yeah, mate. And look, I can see Maya has put a link in there for people who want to join your show, I think. So if you do want to subscribe to the show with Ash and Jeff, jump on the link, do the paid show, the US Open show from 9 p.m. to 10 p.m. Singapore. Yeah, mate, I think that's fair. I think one of the things with this stuff is that really good psychology comes from using the tools, right? You have a plan, you stick to the plan, you get some data, you test the data, you evolve the plan, you stick to the new plan, you get some data, you test the data, and it's just an ongoing process. And where it falls down is the minute you leave the plan. The minute you leave the plan, you don't have any data of any use anymore to test against, and the whole thing becomes a little bit redundant. And I'd suggest to you that professional traders spend as much time working on this kind of stuff away from the screen as they spend in front of the screen and in front of the market making decisions.
Yeah, absolutely right. And that's the point. If somebody was to say to me, I've got a strategy that works, my first question is, how do you know? How do you know it works? And if they just tell me, oh well, I trade it every day, that's not good enough. I mean, I kind of want to see, I want to hear them say, because I've tested it. You know, I've tested it. I know it works, and I can tell you exactly what percentage of time that my strategy works in certain areas and in other areas that doesn't. So I think as specific as we can get about our approach, the better. We're analyzing charts. What is a chart? A chart is just printing numbers, visually printing a number on the chart for us and making it look easy enough for us to make a decision on. It's not really a kind of a group of pretty shapes. It's actually data. And that's what this game is really about. It's about analyzing data, and we can analyze ourselves through data, but we've got to make sure that we collect that properly.
Look, I've got a question here, and I think it points to one of the things. I'm going to read it out. I did mechanical stage and journal, but I still struggle between TP1 or TPO versus leaving it to trend, thinking it's just a retracement, or getting a larger profit, but most of it reverse against me and make a loss. Please talk about the psychology of this dilemma. It sounds like you're making decisions and getting into blame. And trading psychology is about having a plan and following the plan. So if your plan is to come out at TP1, come out at TP1. If your plan is to come out at half a TP1, come out at half a TP1 every single time. If you're trading, whatever you're doing with the rest of it, do that every single time. And then have a look back when you've got your 20, 50, or 100 trades and see what worked and what didn't work. And what you might find is in the strategy that you're trading, train tracks reversals don't work. Test bars are it, possibly. You might find that when you're setting TP1 in your strategy, that setting targets for TP1 a couple of, at a resistance level doesn't work. You've got to set them 5 pips before the resistance level because everyone gets out before the resistance level. But if you look at a bunch of charts, this stuff will jump out at you. Whereas if all you do is sit in the market and make decisions all the time, there's nothing to analyze, right? What you've got to do is you've got to trade, as Ash calls it, mechanically, by the rules for a period of time that's long enough to create some data that you can use. And look, I mean this with complete and utter love, right? But your opinion is not a strategy. Your opinion is not a data point. You've really got to follow the rules and trust the rules for a period of time and evolve them slowly, and achieve that. Eventually, for people who've been trading for a lot of years and struggled, what happens is that the baggage of that starts to undermine everything they do, undermines their decision, creates doubt, and they start making a lot of decisions in the middle of trades that don't work out for them, and that then take away their ability to create meaningful data. And meaningful data is really, that's a really another great question here. We've got maybe another couple of minutes on this before we're going to do our prize draw, Ash. But Ash, do you want any more on the first question there?
Was that first question on YouTube?
No, it's on. Instead of putting it in the chat, they put it in Q&A.
Okay.
It's a bit harder to find. We would ask in future, guys, please, to try and put these things. I don't think I've answered a couple of questions on YouTube.
I see it. Yeah. Okay. Yeah. So I did mechanical stage.
I'll just check the Facebook stuff as well. So if there's anything else we need to get into here.
Okay. So let me. My take on that, Jira, is that it sounds to me like you've done the mechanical stage and journaling on the entry, but not on your management, because there's obviously two sides to the trade. You know where you're getting in, but you maybe haven't analyzed the best places to be getting out. So if you've done the first part of it, you're halfway home. I'll just say go back and now put in a separate part to your journal. So you've got entry on one side, trade management on the other side, and start looking at the trade management. And it's a common mistake, actually. Everybody kind of focuses on their entry. I've got a really good entry here. It's brilliant. But then they don't focus on really what's the important part, which is how do I make money out of this when it's running. So I would say that you probably haven't done the full part, the full round of the analysis just yet. So maybe go back and put a column into your journal which just talks about management, and then start to analyze where you've been coming out and where would be better, and that will give you another set of information that you need.
And while you're creating the data, don't have opinion as part of those points. Come out at a set time every time in the same way.
Yes.
So you get consistent, so your data is really consistent. Look, one more question. If you want to put any questions in the questions box, we will try, but I've got to get out of the show in time to let Ash and Jeff get underway at 8:30 for live and free the US Open show. That'll be on YouTube as well, or on Facebook. You can just log into that stuff as well if you're in the show. Sometimes we see all strategies are logical and good, but how do we know what is right for us? Do you want to do a quick one on this before me, Ash?
It's really simple. Find out. I mean, it's, and I don't mean to be flippant about it, but you'll know what's right for you when you find out. You just have to go through mechanical stage one, and it's as I say, this stuff is going to be quite tedious. But when it's done, it's done. And when the work's done, it's finished. So you try one strategy, you test it over a course of 20 trades. The next one, and then the one that's right for you, the one that's making money, I would have thought. But it's also the one that you enjoy analyzing and looking at. But it really is, the answer really is just find out, and you can.
Look, I want to jump into that. Look, it's one of the things that I think it's kind of amusing to me that sometimes people think that trading is different to anything else in the world. So the question fed to me is, how do you know you've got the right car? Well, you've got to drive a few cars and find out which one feels right? You don't just, I think people expect that they're going to try a new strategy and all of a sudden the whole screen's going to start lighting up and Christmas lights are going to boom out and go, hey, this is your strategy. This is the one. And you've just got to test them. And look, I think often you just know. And I know when people say you just know, that's such a wussy thing to say, but it's just the truth in this case. Definitely for the test, you've got to have the same strategy for the same strategy and the same rule for the 20 trades. If you want to work out how you're going to trade, you've got to take our strategy and trade it through. Look, I'm going to ask Maya to help us with a prize pool, a prize draw before we do any more. But we'll see if we can get any more questions in before we go on, but we really are running out of times. Maya, you ready to go with a prize draw for today? The winner of the prize draw today gets 1 month free of Learn to Trade US with Ash and Jeff. One month free with Ash and Jeff and Learn to Trade Live US. Maya, you ready to go with the prize draw?
Yes, we are.
Great. If you can do that, can you grab the screen and do the draw for us, please?
Okay, hold on. Okay, so I will be drawing now.
Cheers. Thank you. Now to win, you've got to be in the room. So we'll see who wins and we'll see if they're in the room. Gosh, it's pretty hard for me to tell.
Ellie.
It is Ellie. Ellie, are you in the room? Can we have a quick look and see if Ellie is in the room at this time? Ellie, if you're in the room, we are going to give you a...
Ellie is in the room, yeah.
Ellie is in the room. Congratulations, Ellie. You are a winner. You will get 1 month of Ash and Jeff's. Hey, Ellie, you got your hand up. Congratulations. Look, I only own the company. I've got no idea how we're going to get in touch with you, but we will get in touch with you. We'll have some registration details from you. So the team will reach out to you tomorrow. We'll put you into Ash and Jeff's free show for the rest of the week, the rest of the month. We won't be able to get you in tonight's show at this point, I don't think. If you do...
Not free show, you mean the paid show?
The paid show, yes, the paid show. If James is still in the room, if we could send her the link, that would be good. But I think James might have shot out of the room after he fixed up the problems on the live stream. Hey, look, I want to talk a little bit about, first of all, Ash, I want to thank you very much. I think, people who have come along and prepared to share openly and honestly about what it takes to be successful at trading are incredibly valuable. And I thank you for your time and I thank you for your insight. And it's always nice to hear what you have to say, mate. And I think people really do appreciate it. So thanks for coming in. Guys, my plan with this show is every week to have somebody come in here and talk about something that's of value to you guys. And I'm interested in the big picture stuff about what's of value to you. I'm not interested in hearing we should do analysis on one chart for 5 minutes to find out whether we should take a trade. I'm interested in how we make you guys better traders and what you guys really need to become better traders. I'm going to bring guests along every week who are going to focus on the things that you tell me you need and that I believe you need. So please let us know what you think you need to become a better trader. Trading psychology for me is the absolute wrap around everything, right? Cyclicity on a chart is the most important thing for me, and trading psychology is the thing that you wrap around everything. And what we hope is that over a period of time as you trade, trading loses its luster. Then you stop worrying about money and you just look at the picture. And if you just look at the picture and do what it tells you, trading is, and I'll be careful of my words here because I want to be really clear, trading is simple, it's not easy. What's happening on a chart most of the time is a pretty simple thing to understand and a pretty simple thing to work with. It's just, while it's simple, stuff gets in the way of us making those decisions, and it's often our own biases and stuff. Step out of that, look at the chart, trade what you see, and do it from a neutral point of view. I don't know how to explain it, but you've actually just got to ignore whether you're up or down. It's like, for me, it's like going to the horse races and backing all the outsiders because they'll pay more. Well, they also won't win, so you're just going to waste your money, right? And trading's a similar type thing. Jeff's done everything. He's also been a bookie, hasn't he? But what you want to do is look at the chart, see what is going to happen, and back that. And if you look at a chart with the knowledge that most of you guys have got, most of you are our clients, you have enough knowledge to be able to look at a chart and go, that's going to go there and bounce. And if you believe that, then in my view, as you get discretion, you can trade it there and trade the bounce. What you can't do is say, I need gold to go up, so I'm going to buy it, because that'll never work. Cheers, guys. Thanks very much for listening. Any final thoughts, Ash, before we jump out and let you guys get ready for the UK live show?
No, just very, very quickly. Jira's asked a question about a trade, which I'll cover in the UK live show in 10 minutes for you, buddy. So just hop into that show and ask me the same question, and I will talk about that particular trade. Not a problem at all. And we'll be back to trading in 10 minutes, 8 minutes, 7 minutes actually. We'll be back to talking about trading. So no more psychology for now. But if you jump into that show, ask me anything about the analysis of trades, and I'll get to those questions in that particular section in 7 minutes' time.
The good news is that James has given Ellie the link, so she will be in the free show and then in the paid show, guys. How much is it, Ash, to spend a month with you and Jeff for an hour a night?
I think it's $30, but I can't remember, mate. I can't remember.
Yeah.
It's
guys,
not
it's
a lot.
great value. Jump in there and look. We're on a mission to get to 1,000 YouTube subscribers by the 10th of November. If you're not subscribed, I'd appreciate it if you can subscribe. When you get to 1,000 YouTube subscribers, you get a few benefits that can help us to run things a bit more easily. So please do that. And Ash, I really appreciate what you just said. I really appreciate you're going to finish this show and you're going to go out and try and help people to make good decisions, go through some stuff in the market, stuff that we can't do in a show like this.
Yeah, no problem. Yeah, no problem.
Look, Fred, there's no plans to increase the price. Value for money, it certainly is, and thanks for that. It really is. It's an amazing session. And guys, be careful tomorrow. It's non-farm payrolls. I just have a feeling we might be in for a bouncy day. So we'll be in for a quiet day and then a bouncy day when it happens. So be a bit careful tomorrow. I wake up Monday. I bought the new headset today, Rob. It cost like $30. It's a pile of crap. I'm going to buy another one tomorrow. Cheers, guys. Have a good day. Trade well. We'll talk to you guys in next week. Spend the weekend doing some review and put this to use. Honestly, I'm going to say this. Sitting in all the sessions is neat. Sitting in the sessions and using the stuff will make a difference. Trade well, guys. Have a good day. Over to Ash and Jeff soon. See you guys. Bye.
See you later.